well as investors. I just want to point out, since Dave Burkus is online, Dave and I are co-hosts of a podcast called TCA Crossroads, where entrepreneurs and investors connect. We talk about different things that are important to both. We talked about options and equity last week. That podcast will be posted. We talked about some programs that we run called Medical Monday, Tech Tuesday. We have also talked about other topics of interest. And if you have any topics of interest, put them in the chat box. Dave and I will take a look at them. And we're always looking to interview people as well. But today, we're going to be talking about what investors want to hear and what they don't want to hear. So I'm going to start off with what we're trying to do. And by the way, if you have a question, put it in the chat box. I mean, feel free to interrupt. I'd rather have a dialogue than a monologue. The overview of this presentation will focus on key insights, and we'll learn what to emphasize and avoid in business pitches. And we did a business pitch yesterday. We talked to 4 companies, and I can honestly say if I go through this list, the 2 companies that we are putting forward into due diligence fit the mode of these are the things we wanted to hear. The ones that didn't go through fit the mold of the things we did not want to hear. And I'll try to give you specific examples. And if you know of other examples and you want to contribute, more than happy to have user-generated content in the chat box. So feel free to do that. But right now, let's take a look at why startups fail. And they fail because the product or service doesn't meet the need. That's the number one thing. Lack of liquidity. We've seen companies go out of business because they've run out of cash. This happened, significant happenings of that were in the COVID era. Team failure. This may be because the CEO is not good or because the team is just not aligned or they're missing pieces. There are more successful competitors. Pricing or cost problems are an issue, either the pricing structure or the cost structure or the margins are not adequate. Lack of a clear business model, bad user experience, poor marketing, it goes down the list. So when you think about why startups fail, put that in the perspective of what we want to hear and what we don't want to hear. So that, and I think that's a critical understanding. By the way, the number one reasons why startups succeed, other than leadership and other than product market fit, which obviously are the converse of these things, it's luck. It's a matter of timing and luck. Just an FYI for you. So what we want to hear in a strong leadership team, the leadership team had prior experience working together. They may have experience, they should have experience in the market space itself. We heard a company yesterday that's in the gaming market, and they all were gamers. They showed pictures of themselves at like the gaming shows. They have had experience in the market and they've worked together. They also went forward into due diligence. A proven track record on execution. You can have as many great ideas as you want, but the key issue, especially early on, is execution, because you want to ensure that you do better, at least as good as, if not better than your business plan as you go into the next round of financing. So you take a look at some of the great strong leadership teams. Collison Brothers built a trusted team early on. For Stripe, Lori Torres, if you know Lori, is one of the locals. She built Parcel Pending into an automated, really successful automated locker system that was eventually taken out at a 22x. She had experience in operations. She brought in advisory teams. So when you look at a leadership team, it's not only the person, the CEO, who complements that CEO, who's on the board, who's on the advisory board. How do you use the advisory board would also be a very important thing. And of course, the one that we always hear this, if Elon Musk is an advisor or a known entity, yeah, we're pretty much interested in listening to them and going to the next stage. What we don't want to hear is unbalanced or incomplete team. We don't want to hear, for example, that, yeah, we know we're missing the sales and marketing person, or if it's in the medical device, the medical arena, we understand FDA approval is critical. We'll eventually pick up somebody or bring in a consultant. We need to define critical skills and we need to define the compensation for those. Solo founders or solopreneurs, as we call them, with no complementary skills on board, probably too high a risk. So when we think about why we want a very strong leadership team, and it goes along with the other components of this talk, we want to de-risk our investment. Key opinion leaders joining the team, that's really critical. Industry leaders or influencers would be advisors or team members. They can make introductions. For example, I work for a small startup, and they did work in the Defense Department. Also notice a spelling error there on defense. But they had contacts in the government. We were selling to the government. They helped us with those contacts, getting in front of them, creating awareness, and they provided talks at the security conference. The big one is called RSA. Moderna attracted key scientific advisors, lending credibility. Another one, head of orthopedics at Hoag, is an investor and advisor to a product. I can't mention the product, but when we heard things like that, that is extremely important because, again, that tells us there's a good opportunity. And if the KOLs are putting their name to a product or a company, that we believe is good. It's even better if these KOLs have invested in the company. What we don't want to hear, no KOLs or industry leaders, don't worry, we'll get them. We want to see reality today. We don't want to really bet on the come again. It's a matter of risk reduction. Traction. This is a difficult one because in some cases that we look at, we tend to look at pre-revenue companies. So traction may not be actually revenue. It may be something else. It may be agreements. It may be partnerships. But what we want to hear that there is some kind of traction that will lead to financial success. We want to hear about early revenue. We want to hear about early beta. Who's in the beta program? Will they be the cornerstones for what we call a relationship sell, or I'm sorry, not relationship, a referral sell? They will be able to help us make the sale to the next person. We want to see multiple routes to revenue for diversification. We can see, for example, on certain kinds of companies with SaaS companies, there's SaaS revenue. Maybe there's a percentage of sales as well that's in the marketplace. I don't know, but the different kinds of revenue routes that you have, the better. If one route fails, you still have a reliance on the others. We want to take a look at whether or not this is a platform or a singular transactional product. Is it WD-40, or is it a platform upon which you can cut and slice and dice it, for success? A platform would be something like a Microsoft Office, which has several different products in it versus, again, WD-40. We want to see successful beta tests, signed letters of intent, partnerships. So for example, Slack's rapid adoption during the beta led to massive growth in the cybersecurity business. We've also seen try it, you'll buy it. That would give us a good indication that there is interest. The question then, of course, is the conversion of the trials to actual users. We also want to hear, for example, that there's a relationship with the influencer market. We just TCA invested in Fuego Dance. I'm also an investor in that. Fuego Dance just contracted with a celebrity Dancing with the Stars panelist, Derek Hough, for designing shoes. That was really positive, and we believe that's going to be successful because of that. It's the old Nike signing Michael Jordan kind of deal. What we don't want to hear, no validation, no market research. Anecdotal data is better than none. Third-party data and studies are okay if you don't have firsthand knowledge. We don't really care about being the first to market. I want to ask you a question, and you can post this in the chat box if you so desire. Which company had the first portable computer? If you know it, You can post it. If you don't know it, I'll come back to it and tell you who it is later. We want to hear that there's a large and growing market, clearly defined growing market opportunity, supported by market research, either top down or bottom up. For example, Airbnb presented a rapidly growing market in the shared economy. It was a brand new kind of business model as well. That uniqueness was very important for their success. Of course, when they went to get funding, it took 40 different presentations before they were able to get acceptance by one of the VCs. So when you do something new and different, it creates a problem, but you have to show that the market is large. Come up with analogies, anecdotes, show early successes. I think that's the way you want to, show that that there's a large and growing market. What we don't want to hear is the market is trillions and trillions of dollars. And then we look at the business model and it says that in 5 years, we're going to have a revenue of $20-30 million. It doesn't compute. I've heard this before. I'm sure you have too, and you may have even presented it if you're an entrepreneur. We just need 1% of this market and we'll be a billion-dollar company. Yeah, if I can get 50 cents from each Chinese person living in China, I'd be a billionaire. It's not going to happen either. Vague market claims. We want to understand your assumptions. We want to understand your strategy. We want to look at a realistic TAM and SAM, cut it down into the smallest market that's large enough where you can gain traction, become that gorilla in the market versus what we call the chimpanzee. High potential returns. We want to hear for a tech and consumer company, high returns within 4 to 7 years, earlier if there are certain milestones that are met. For example, Zoom's meteoric growth resulted in early returns for their investors. I invested in a company called Paradigm Diagnostics. They didn't give me my 10x return, but it brought me 2x in 2 years, and they were bought out by Exact Sciences. Parcel Pending, as I mentioned before, had a 22x return in 4+ years. We want to hear a solid go-to-market strategy, a clear, well-defined. What are the strategy elements? What are the tactics supporting those strategy elements? An organization that matches the go-to-market strategy. You have to relate who is going to be in your organization. Do you have the right people? Do you have the right advisors? Do you have the right consultants that help you execute on that go-to-market strategy? Peloton, for example, disrupted the market with an innovative subscription model. How they did that, how they went to market was really critical to their success. Think about, and many of you are old enough to remember AOL in the 1980s, when you can go into any store and pick up a disc. These are these big floppies. Try it and then buy it. That was a unique, different market strategy. What we don't want to hear are these vague GTM or general marketing strategies. We're going to use social media. We're going to get influencers. We're going to use distributors. Doesn't tell me enough. We need to get down a little more specifics. Examples, letters of intent. Let's say I'm in the computer business. Having a relationship that's signed with CDW would make sense, or with Ingram Micro. If you're going to be in the medical device and medical arena, having people on your advisory board going out to named conferences. If you're in the cybersecurity business, having the ability to be on the panels at the RSA conference. Those things are very specific. So you need to get more specific than vague and general. Make it very special and make it pertinent to your business and make it understandable by the investor. I think those are real critical. We know that medical is a little different, very different in many ways than technology and consumer and other businesses. There's a long FDA pathway that could create additional problems, could create risk. What we don't want to hear on go-to-market strategy and on these FDA pathways is that there's a lengthy regulatory hurdle without clear timelines. We need to be able to understand, have you talked to the FDA? Who do you have in your regulatory strategy group or person that can help wend their way through the FDA? Because we'll make judgments. Remember, when we look at a medical device, molecules, diagnostics, whatever, it's a very long process. Most of these companies will be taken out well before it goes into commercialization. We want to, again, de-risk our investment by understanding where the rub points are or where the risk elements are. So we need to make sure that there's an expert on the staff. What we don't want to hear is, don't worry, we know how to do it, or we've done this before. We like to see specifics. We'd like to hear about strong intellectual property, patents, and differentiators. We also understand that patents alone don't necessarily guarantee that you're going to be successful. Remember, I asked the question, who was the first PC, mobile PC? It was the Osborne computer. No one has probably ever heard about that. And no, it is not Ozzy Osbourne who had invented that. Totally different person. What we'd like to hear is a robust patent portfolio or trade secrets that provide sustainable differentiation. Sustainability in how you're going to do this becoming different is really critical. For example, Tesla's IP strategy helped build a competitive moat. I don't know if everyone has the same kind of strength in their IP. We hear, for example, for many technology companies that we have trade secrets or we're using AI. You need to understand, you need to be able to explain, are those copyable? Or what do you do that's going to make it less copyable? Maybe you have an LLM if you're using AI that's unique because you have a different data source and you're the only ones that have that data source. Or maybe you have what they call strategic control points. There's a guy named Slywatsky. He came out of CSC Index, I believe. He wrote a book called Strategic Control Points. Pretty interesting. It's an older book, probably in the late 90s. But he talks about ways you could control things and make yourself different and sustainably different through building a brand, very costly, distribution, partners, unique skills, raw materials, or logistics. What we don't want to hear is a lack of IP or trade secrets. First to market doesn't really make a difference. The Osborne computer was first to market. It didn't last. We don't want to hear that there is no competition. And competition could be real or imaginary. For example, I put internet on the airplane when I was with Boeing, and we thought that the competition was the in-flight entertainment program. And the little seat back things. And we found out that was not the case, that the competition was actually eating, sleeping, reading, and other activities on board. So you really need to understand the competition. Again, it goes back to market research. You need to understand who your audience is and how you're going to compete. Risk reduction and mitigation is really important for us because we want to de-risk our investment. What we want to hear is clear identification of risks. We'd like to see prior investment by other trusted angels. For example, Dropbox emphasized security features early on. That was important for people because we're putting things in the cloud. Here's a risk impact model that I have used in the past. Boeing has used it. There's risk on one axis, there's impact on the other, and you're just cataloging where your risk elements are. Maybe it's regulatory risk, maybe it's political risk, maybe it's monetary risk, maybe it's competitive risk. The R's in there would be the defined risk that would be put on a separate page. And the issue then is, how do I move, for example, R4, which is in that 2-3 box up in the middle top, down into the yellow or into a green category where there's lower risk? That becomes really important. And here's what it would look like. So, for example, here's my matrix on my left-hand side, and there's the risk R1, increase in product-based R&D doesn't work. We want to move it from HH, this was R1 up here. We want to move it to something else. This is an actual case. I didn't fill it out, obviously. It gets really small in the writing. But you want to be able to use something like this, work with the investor community. But in my opinion, entrepreneurs should understand their risk level up front and be able to tackle it before the investors really get into it. Um, what we don't want to hear is no identification of risks, or and we certainly want to hear mitigation strategies. When you say we understand the risk, we'll work on it, that's not pretty acceptable. I always believe in looking, at the future. It's like Wayne Gretzky said when he asked how you're so successful. Well, he said, I skate to where the puck is going. In a sense, risk and risk mitigation is understanding the future and making sure that you understand where things are going. The one thing that I've heard, and we hear this many times, we have 120 years experience in this market. Well, it's a trust us. We don't know you that well. Hate to be so blunt, but the years of experience in the market doesn't guarantee success. I was one of the early employees at MCI. I think it was number 100. There's a guy named Bill McGowan who was an attorney. He was successful in battling AT&T in that era of 1968, 67, because he didn't have that experience. Therefore, he wasn't constrained by the models that existed today. Same thing with Airbnb. So just an FYI, make sure you understand the risk, make sure you understand how to mitigate it, put it into your package or have it as an FAQ when you're presenting to the angels or the other investors. Funding and non-dilutive funding. This is really critical because we're getting into, are you going to give us enough so we can make money? We want to see a structured funding plan. We want to see non-dilutive sources like grants. This is particularly important in the medical arena, or grants that are available through Department of Defense or NSA for military work. We want to see the founding team is all in. Obviously, the founding team is really critical. How are they getting compensated? Did they put money in? Did your board of directors provide any funding for the company? Have the advisors invested? All those things give us a surety that this has legs, that your business has legs. For example, this is the simple one, a biotech company leveraging government grants to reduce early stage dilution. We like that. We'd love to hear it. It doesn't mean that other investments don't make sense, but remember, when we look at something early stage, we're going to see additional rounds of funding. Understanding that strategy so we can understand our dilution becomes really critical. We don't want to hear an unrealistic funding plan. No clear plan for funding the next rounds. This is particularly important if you're thinking about going with a safe instrument. Most of the angel community will not do anything other than a safe that's post-money safe. We will not do a standard safe or the old safe. We will not do a pre-money safe in general. So we want to hear what your funding plan is, when the safes are going to come to maturity and convert. What is it going to convert to? Where are the warrants? Are you relying on equity alone, or are you going to do funding of your receivables? Or are you going to use debt? That all has an effect on the bottom line, has an effect on valuation, has an effect on the exit. I love this. I heard this yesterday. We had this company do the validation of our market cap, and they said that our market cap is $20 million. We also went to a VC, and they loved this thing. They said they would invest, and it's pretty reasonable at $20 million, but they want the angels to invest first and have first crack. If it's a really good deal, people don't turn away deals. They're doing that to assuage any concerns or make you feel better. But the reality is you cannot come back to an angel or other group by saying, we're going to give you a deep discount from what we presume to be the market cap. We have a lot of experience in TCA. We have over 400 investors. We've done this for 28, 29 years now. We've seen literally tens of thousands of deals. We have a pretty good understanding of what's realistic and not. We saw the high valuations during the COVID era. Thankfully, they've come down, but they're now starting to creep up. We make our money on the exit, not on the initial buy-in, unless there's some unique kind of funding plan or compensation plan for the investors as a sharing of profits or sharing of revenue. So we are really concerned about funding where it will go because this is the way we're going to look at our return. And most of the angels will look at a 10x return. The conclusions on this whole thing, I know this is really short and quick. This is my New York style. Make the presentation relatable and personal. Emotion and passion sell. I remember listening to a presentation probably about 10 years ago, so fairly early in my investing career. And the person got up there and said, I have a problem with diabetes. My sister, my whole family is affected. But I'm into sports. I need to do something to help all those people not have the reliance on these big, bulky dialysis machines and checking my blood sugar level. So I'm committed for this. My goal is to make sure no one has the same problems that I do, and I want to make it better for everyone. And he made it very emotional by saying, does anyone know anyone with diabetes? Do you have it in your family? That relationship and that relationship building and that emotion and passion came across. And I'll never forget that. So what you want to do when you make a presentation is not necessarily get money. It would be nice, of course, but the real goal in a presentation is to say, is that the angels or the investor to say, tell me more. I've said this, many of you have heard that before from me. It's to tell me more. And to do that, you need a good, crisp elevator pitch. You need a good relationship building, emotional type of a hook. And you need to tell the story that includes all the things that I mentioned in terms of what we want to hear and avoid those things that we don't want to hear. But telling the story is really difficult. As Mark Twain said, you can tell a story. Many people say you can't do it in 12 minutes. Yeah, you really can. You can't tell the story that quickly. But Mark Twain said, I'm so sorry that my letter, he was writing to somebody. He said, I'm so sorry that my letter is so long. I didn't have the time to make it shorter. You have to have the time, the wherewithal to really practice and make this pitch poignant, relatable, and personable. And I guess that's really the real key. When you tell the story, you want to know, is there a growing market? How are you going to sustain a differential advantage? Do you have a strong team to execute your go-to-market strategy? Is there a good financial plan? And do you have a good exit strategy? That's what we want to hear. And then the investor, the angel, TCA, whoever you go to will say, tell me more. And then you go into the next stage of their process, hopefully in due diligence. And then you get your funding either through one of the funds that you have, that the investing groups have, or through sidecars or a combination. So that was the quick view of what we want to hear and what we don't want to hear. And hopefully it's useful. I'll take any and all questions relating to this or anything else you want.
Open to questions. All right, we have two questions. Thank you, David. That's great. Man, you went through it fast. All right, so
Yeah, highly caffeinated this morning.
well, you can review this and take it slower because it is recorded and it will be available on the platform probably later on today or first thing tomorrow. So if you log in again, go to the auditorium and go to today, and then you will see it will say play or watch instead of join in the across from this webinar. The same thing for the webinar this morning and all the other webinars and presentations and panels. All right. And
By the way, I
also,
noticed on this thing, Rick May had an Osborne computer. I remember schlepping that bloody thing on a flight, and I don't know if I can do it at my age now, but boy, that was like weightlifting. It was It was humongous. It was like a suitcase.
Yeah, that's true. All right. Also, I'll mention that it's also being recorded and it will be on YouTube as well for Pismo Ventures YouTube channel. So you can find it all there and you can review and take it slower. All right. So we have a bunch of questions. You want me to read them or you want to read them?
Absolutely. Yeah.
All right, I'll read the first one from Robert. Why the safe note? Runaway cap table, majority risk on investor, no convertible note. Please explain further.
I'm not sure I understand the question
I
entirely,
yeah, I think
but
when you were talking about safe, that was when he posted it, so I didn't
yeah.
want to
So a
interrupt. Oh
safe
yeah,
note basically um, is for future equity. So in a sense, the early safe that was developed by, I think it was Wilson Sonsini, basically was an IOU. It said, trust us, we'll give you equity. We're not sure what it will be, but don't worry about it. And those safe notes were really good. They're great for friends and family because friends and family don't really care as much. But when you go into groups like TCA or other investing groups, we want to have a little more certainty in what we're buying into. So with the traditional ones that we've used are preferred equity, convertible notes. And in those instruments, there are things relating to governance, conversion, liquidation. Most of the safe notes that we've seen, although they've changed over time, uh, will include when you will convert that safe. Because what we've also seen using safe notes is one safe note, then another safe note, then another safe note. So if you're an investor, and like what we'll do is we'll do a side letter or we'll change the terms, especially if we're the lead investor on that safe note to include a trigger so we can do the conversion because we want to know with certainty what we're really buying. That's the concern about the safe note. When it's post money safe, we know that it's guaranteed and capped at that valuation. So we make the post safe note, other than some governance issues, are basically like a convertible note. But still, many of the angel groups won't take post money safes anyway.
yeah. We talked a bit about all this with Dave Burkus as well. The safes are, most, they're popular, but they don't make sense to most angel
Well,
investors and
but at
VCs.
least if they do it, JJ, they should at least come up with a post money safe. That would
Right,
be the
exactly.
idea.
And the idea, the one thing I think I should have mentioned earlier and talked with when we spoke with Dave as well, is that everybody tries to say, "Oh, my attorney will write it, and it will look like an equity thing, and it will be." There's no such thing. That's what I've heard many, many times. Um, it's a note. It's a promissory.
Well, there's another issue with both safes and
Yeah,
convertible. Well, it says it's a future equity.
yeah.
We in the investment community relish the opportunity to do a 1202, which means that if you invest in a company with equity and you're an early on equity buyer, original equity buyer, if there's a liquidation event that is 5 years and 1 day, there is no federal income tax on that up to $10 million. In the states, there are certain states, I think there are half the states tax the 1202 event, half the states don't. If you live in California, if you have $1 million, um, uh,
Capital gain.
$1 million, yeah, if you made $1 million on the deal, you're going to be taxed at 13.3%. If you live in Georgia, then you're going to, where my son lives, I'm just throwing that out there. But when you live in Georgia, you do not pay state income tax either, just an FYI. So a safe will give you nothing, nothing until you actually convert that. You got to talk to your accountant, your legal team. If you have a safe with interest, it's clearly looking more like a debt conversion. If you have a safe with no interest, it's looking more like an equity, but unknown what the valuation is. You may be able to treat them differently. The IRS hasn't been able to figure it out yet.
Right. And the clock doesn't start until it becomes equity.
Correct.
It's not equity from the beginning. All right, next question we have from Yaya. What does the investor appetite for risk look like going into 2025, particularly for early stage startups?
Yeah, it's funny. It's a great question, and it's really it's we're seeing a couple of things. I see things differently. JJ may see things differently. Dave Burkus may. We all see things from different angles, like looking at an elephant from different points. I'm seeing a lower tolerance for risk because there are more alternative investments that accredited investors can look at. So we're also seeing younger investors coming in. They are also relatively smart and looking at the returns on their investment. They're not necessarily saying, I'm looking at an angel investment, I'm looking at a return there. So the type of investor today is looking at, if I have X dollars, where can I put my money to get the best return relative to the risk I incur? So it could be in NFTs, it could be in Bitcoin, it could be on structured notes, it could be on early stage, it could be on later stage, it could be on different market spaces. So we're seeing that I've seen that, and I've heard from my colleagues that we want to reduce our risk. And that makes sense because there are other options available. So I'm hearing more and more of the risk reduction. That's why I said if you're an entrepreneur, come up with the risk mitigation strategies, share it to make sure that you de-risk the investment to an investing group. JJ, you may want to add to that.
No, I mean I agree to that. The other thing is when startups come to us and they say, "Oh, you're gonna, this is an opportunity. If you don't invest, you're losing." Um, and 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 the reality is, we see so many, and 95 to 99% of the companies are probably going to fail. So, if you try to push investors to invest because they're losing on an opportunity, it may look like it's not a great opportunity because you're pushing in the wrong direction.
Yeah. Fear,
Um,
fear of missing out is not a reason for investing.
yeah, absolutely not. Investors, especially the ones that been around for a long time, I could tell you they will know if there is a real opportunity from the first probably 5 minutes into a presentation or even less. Because not only because of the presentation, or it's because of the team, because of the market, because of many things. It's very quick that we make decisions as to we want to see someone further to learn more or to do due diligence. All right, next
So let me
question.
let me follow up if I
Yeah,
can for
yeah,
one
yeah,
second,
yeah.
because I think you're spot on. It's like when you interview a person, you know in the first minute or two if that person's going to be good. The rest of the discussion is going to either confirm or deny what you
Right.
believe initially. So the real key on this thing, and I've done another presentation. It's also online. It's in our podcast. It's called The Perfect Pitch. Make sure early on you have a really strong elevator pitch, who your target is, what your technology advantage or sustainable advantage is, what the benefits are. And then the key is in that second sentence, unlike competitor A or the competition B, this is what you do that's different, and this is why you will succeed. That's going to give us at least a prejudicial view positively that this makes sense for us to even consider and listen more intently.
Yeah, absolutely. I mean, knowing that there's an unmet need, or knowing your sustainable competitive advantage, and knowing um, your buyer, who your customer is, and how you're gonna get to them, those become like huge. You could have a cure for cancer, but if you can't sell it, you can't market it, you don't. It's a bunch of a lot of things. It's a village to build a
Right.
startup. It's a village to not only build it, but to market it. It's a village to sell. It's a village to have your customers and know who your customer is. It's a nonstop, um, you know, experience that you need to be on top of it. And then yeah, we know because we've done this for a long time. We will like David said, it's the rest of the time that you're spending to explain to us, it confirms or denies um, if you are the right person or if this is the right startup or not. Question from Chad. Could you elaborate on some terms of deals you are actively looking as an example, looking at as examples, especially for early stage life science technologies?
I'm trying to
So
understand if it's the
term,
deal structure.
yeah, the term of the deal for life science as examples we've seen.
Yeah, so in life sciences, we just saw one for Clear Cut Surgical. The deal was for, I think that one was for preferred equity. I'm not 100% sure, but it's either preferred equity or a safe. The what we're seeing, if there's really strong IP, the valuations are somewhere between 8 and 20 million. So it's a big range if you're asking for what the valuation caps are on these things. We're seeing more safes than convertible notes, which is kind of interesting. Don't know why. If you go on our website, tcaventuregroup.com, you can go on to communications and look at the annual report that John Harbison puts together, and he'll break down the deals that we did. You can see the kind of deals, life sciences, you can see the kind of in technology, you can see the kind of instruments. But we're seeing in life sciences deals that are um, that have grants that are a variety between, depending on how early stage, if they're at the conceptual stage, they're coming out of school as an IP, if they have mouse models, if they've done, early tests. It depends on where you are on the testing stage. That relates to the valuation, and that relates to also whether or not it's um, the first raise or the second raise. But all the early stage stuff that we're seeing in life sciences, what we'll do is we'll invest in deals that are below 20 million, basically. If it's above that, there should be a lot more traction. I don't know if that really answers it, but because there's so many different ways you can look at that question. So if
Yeah.
you want to follow up, ask another question. We'll try to handle it from a different perspective.
Yeah, maybe you can stop sharing since you're done with that. And
Okay, that's good.
um, yeah, I mean the terms are the same. The valuations are higher. Um, that's what we've been seeing. I think the valuations are higher than
Yep.
I would like them to be. Um, Other than that, they are mostly safe nowadays. But again, like David said, we'd rather see more, um, either convertible notes or equity rounds.
Yeah, so let me give you two that came out yesterday in our deal. I'll give you what they said. One was for uh was going to compete with GLP-1, like Ozempic, and deals like that to try to suppress your taste buds to reduce your sugar intake. That was for a $3 million raise, seed money on a 6 million post money safe. We had another one which was a device for blood clotting, sort of like a tourniquet. That one they had looked at a $2 million note. The earlier round was $6 million, and I think they were looking at about 10 or $12 million.
Although the first one is reasonable.
Uh,
So yeah,
well, it depends. I mean, the one was very early stage. The first
right,
one was higher risk, so
right.
the valuation was much, much lower. The second one, the device has been around and it had that one had revenue. So the
Oh,
second the
That's the
medical device $800,000 in revenue. Therefore, it can justify the higher valuation and the different deal. That's the whole thing. You can't look at it as a point issue. You have to look at it in the context of your revenue, your team, your relationships, your partnerships, you know.
milestones, everything. Yeah. All right. Please post questions in the Q&A section. We have one more um, from Paul. We all hear about the pitch getting to the next meeting. Tell us about that next meeting.
Yeah, so if you look, okay, let me go through the stages at TCA. That may be the first thing. The application goes in, we review the application. Usually it's a combination of the screening head, the president, and the executive director. So they'll see if all the pieces are there, that if it makes sense, that it's not out of the box in terms of the valuation, that it's more than just an idea that's on a piece of paper. So they'll do some preliminary triage. It goes from that application, then it's slotted into one of two or three different pre-screen groups. Could be medical, it could be technology, it could be consumer. Now we have 6 different networks within TCA Venture Group. They do things a little bit differently, but fundamentally that next stage after the application is making a presentation to a pre-screen group. Those presentations are normally between 8 to 12 minutes, and you basically tell the story why this is a good investable opportunity. And when you tell the story, there are 2 parts you have to remember. There's the business aspect. Is there a market? Is it large? How do you make it? What's your technology? And the second one is, investability. What is the financial return? What is the exit? So you have to cover both of those parts, and you tell that story. So again, elevator pitch you're going to do regardless. You're going to build a relationship because you're making a presentation to people, and then you're going to tell the story. If it passes that, there's a thumbs up or a thumbs down. Sometimes we score them, sometimes we don't. Scoring is not critical. You basically go to the screening stage where you make a presentation. It could be the same amount, it could be a little longer. Same basic thing. When it goes by screening, we raise our hands to say, are we interested? Most of us have a fund or individuals that are investing. So when it goes through the screening stage, after you go through pre-screening, we see if there's interest to go into due diligence, and we create a team that is going to be talking to the CEO, and we find a due diligence lead to go through details. Those details could be, you're going to answer our questionnaire, you may bring your deal room because you have prior due diligence, and now it becomes a dialogue between, a team of people representing our network or our angel group or our investment group and the CEO and their team. So that's the way it works. But it's presentations and raising the hands to get to the next stage to engage. The goal is to get into the due diligence stage where you have this interaction literally with people with Q&A meetings. And then the final part of that is we write an investment report and we recommend what the investment or don't recommend the investment. That's about it.
All right. I will kind of add one more thing to this by saying that when you need to have that short elevator pitch that's maybe no more than 30 seconds long, that intrigues potential investors because um, that's usually what's going to say, if you're meeting you meet me or Dave or any of the investors that we know, and then you intrigue them with that, that's going to lead to a potential hey, look, why don't you come to our meeting? I'm interested in meeting with you again. So the next meeting is always related to that first impression that you leave with that investor. So have a really intriguing 30-second elevator pitch that really talks about what your company and you as a founder are interested in doing. All right.
Let me
Next,
just mention one other thing.
yeah.
Of course, I'm part of the Small Business Development Center. And I'm always out in the ecosystem. I'm going to be at the TCN, meeting, TCBN meeting tonight, the Techos Venture Network. If you are an entrepreneur, find me, talk to me, give me your elevator pitch. If you're an entrepreneur, you're welcome to be my guest over at one of the TCA screening meetings. You can see what it's like in real time. It's the best way to really get inculcated into what it is to give a presentation and what we do. There was a question also, JJ, what is is Trump administration positive? I think it will be, because I think he wants to focus on innovation. And, that's what I'm counting on. I'd be shocked, given the fact that he's a businessman and he's, gone through, the improving businesses over the years, that it would be constrained. You still have the Infrastructure Act that could get some money for some of these entrepreneurial and opportunities as well.
Yep, definitely. All right. Well, Yaya has a question. How do you assess a team's ability to execute their business plan beyond the pitch deck, like searching the team, LinkedIn profile, using matrix similar to the risk one that you presented? What do you do?
I'm sorry, I missed the first part of that
So the
then.
first part is how do you assess the team's ability? Basically, are you, because they're there and they're pitching. What do you do to assess their ability? Do you search them online? Do you do
I will I will
background check?
actually do a search online. We do background searches because we've had some unfortunate cases where the team or somebody else did something untoward. The easy search, we can do an AI search pretty simply, check the team, and I've done this using ChatGPT, check the team. Did they work together? How did they work together? I will check references. We'll get a perspective when you talk to somebody and you meet them face to face. You can read the people. You can read whether or not they're honest, they're trustworthy. Those are the things we're looking at. So there's honesty, trustworthiness, because they're using our financial dollars. The other one is, can they execute? And that one you do by either we have tools that we actually can give them, like a DISC program, so we can find out if they're ENTJ, INTP, whatever. But the best way to do it is we ask for input. Who are the customers? We'll talk to customers. We'll talk to their colleagues. It's almost like an interview for a job.
We do, yeah. And we actually do a background check, like a full-blown background check before investing. So, all right, let's see. Okay, so that was a couple of comments, things. Thank you. I have a question for you, since we have time still. So, one is, you did talk about the fact that on one of your slides, a lot of people say, if I get 1% of that market, we're going to be billionaires. So what's the approach? Should it be a bottom-up approach with, how or what would satisfy your needs?
Yeah, so I'm not a big fan. This is gonna sound really strange since I'm investing I don't really care about your Excel spreadsheet. I can do Excel well enough to make it lie. I don't, no, seriously,
Yeah,
because I've been on the other side. But I am interested in the assumptions. So the way I don't want to know it's 1%. That may be an after the fact. By the way, it represents 1% of the market. That's fine. But I'm interested in the assumption set on how you build out that Excel spreadsheet. What are the assumptions in terms of the market? Is it a new market? Is it a share shift? How am I going to share shift? They all relate together. So it's the assumption set that becomes real critical in my mind, and the business intelligence. I look at an entrepreneur in terms of three levels. This is a very different talk. IQ, BQ, and EQ. That's what I evaluate. And I'm not the best probably at this. We have better people, that I'm a New Yorker. I have a very different attitude towards people, obviously, but innate intelligence is IQ. We can tell if you're smart or not by just the way you present yourself. BQ is business intelligence, and that relates to your prior experiences as an entrepreneur or a business person. And EQ is how you deal with the stress of being in this business, because we've seen weird things happen when people get under stress, or things, the risks come about. You get hit by a change in strategy, a change in logistics, a change in your raw material supplier. How do you deal with things like that? Those are the things we'll question, we'll ask and probe to try to really understand the complexion of the leader and the team.
So the E is for emotional intelligence.
Emotional intelligence,
Yeah.
emotional intelligence, business intelligence, and innate intelligence.
So quite interesting. That's really good because a lot of time uh, you really have to deal with. I mean, you're dealing with stress all the time. If you're not, I want to run that business.
Well, yeah, but how you deal with it is really critical. If you
Yeah,
wind up with a problem, are you going to try to hide money? If you wind up with too many difficulties, or all of a sudden you're going to say, screw it, I'm going to close down the business or do a fire sale.
yeah, yeah.
Rely on your board of directors and your board of advisors to help you out. Point is, as an entrepreneur and a CEO, don't do it yourself. Build a good team, value the differences, value the diversity of thought.
All right. One more question, kind of related to my previous question. We always hear companies come and say, we have a bazillion TAM, a bazillion SAM, and a bazillion SOM. I mean, does it have to be in the billions? Um,
I'd like to see a billion. I've heard, I saw one the other day that had like, our TAM is $216 trillion.
oh
Okay.
wow, I haven't seen that in a while.
Yeah, well, yeah, that was a little large. So yeah, if you got 1% of that, I'd be real happy. But it's not important. What's important is defining who your target market is. What does your prototype person look like? That's the key. It's not the TAM I don't care about as much as
Maybe the
who is
SOM is
the
at the end of the
SAM
day.
and the SOM, and how specifically are you going to approach the people that look like David and JJ versus the people that look like my grandkids.
Right? It's a different, yeah. So yeah, I guess one of the things that I hear all the time, because everybody tries to make it really, really big, but if you're going after $500 million SAM, for example, that's already huge. And if your SOM is 50 million, that's already huge. So you don't need to be in the billions. You could be in the hundred millions.
So let me give you a quick thing, if I might.
Yeah.
We were talking about a cybersecurity business yesterday, and the cyber market is really large. We're talking about ransomware, we're talking about, virus protection. There's a whole bunch of things. So the total market for cybersecurity risk evaluation compliance is probably in the trillions of dollars. But when you're looking at a deal, if the person is looking at a ransomware prevention or a compliance, that number gets really reduced significantly. So this total market is a composite of all these various pieces of it. Focus on the piece that you're in. That's really the TAM. And then the SAM is who you're going to go after. The United States, worldwide, banks, reduce that. And the OSAM is how you're going to be successful in getting a portion of that. So really craft your presentation and your market very precisely. Because when we look at the deals in 5 years, if you're hitting $50 million, that's really good. Who cares if it's $500 billion? It kind of looks fluky, you
Yeah.
know,
Yeah, exactly.
especially if you say, well, we're the only ones in the world, then how come you can't get $500 billion?
Yeah.
It doesn't compute. That's the problem.
That's true. All right. Any other questions from anyone? All right. I'll ask one last question. What are your thoughts about companies early stage of do you as an investor require them or you would like to see a board of directors in place before you invest?
I would like to definitely see, well, usually if it's real early, it's going to be usually a board of directors of three people. So I want to see who
Or
that.
one?
Well, if it's one, then it's a different issue. I mean,
Yeah,
I have more concern. I'm
yeah,
really interested in understanding your organization early on and what they're going to contribute than specifically the board of directors, because the board of directors in real early startups are usually the co-founders and one person who's an investor, usually a friend or family. So it's kind of irrelevant. I would like to see some modicum of traction in other areas. I would like to see how much they've invested initially. I'd like to see the sustainable difference, the whether or not this is going to be a novel and new approach or just a better mousetrap.
yep. All right. No more questions, so we'll end it here. Thank you, Dave, very much for
Pleasure.
doing this. That was a quick fire, nonstop. uh,
Yeah.
uh,
So if you replay it on YouTube, go to 0.75 on the speed.
there you
I
go.
don't know. I'm sorry. It's just, I
No,
was
that was
excited. I
good. That
love
was
this
good.
subject and I get excited, so I speak faster.
No, that's great. Yeah, I mean the point is they can review and they can slow it down if that's the case. But thank you again very much for doing the webinar, and thank you for being part of the Global Startup Symposium. I truly appreciate your time and
Always a pleasure, JJ. Anything for you.
thank you. And again, for everybody, please join us in a couple of hours for the presentations for today, starting at 1 p.m. Pacific time. And talk soon.